Hello, everyone. This is what happened. In the last few days, the scramble for physical silver and critical natural resources went from background noise to the main event, not on paper, not on headlines. In the real world, where supply chains break, ships don't sail, mines don't ramp overnight, governments suddenly remember that you can't print a barrel of oil or a ton of metal. And here's the uncomfortable truth. A multipolar world is not coming, it's already here. And the moment that reality hits, the fight isn't over interest rates or stock valuations anymore. It's over who controls the stuff that makes modern life work, energy, minerals, and yes, silver. So in this video, I want to connect the dots. Why the US and its rivals are acting so aggressively around resource-rich regions, why the paper crowd is still throwing punches in thin overnight trading, and why the physical market keeps answering back. Then we'll zoom out with the long-term gold and silver charts so you can stop getting whiplash from day-to-day volatility and start seeing the actual trend. And near the end, I'll show you one ratio chart that quietly signals a historic rotation that most people won't notice until it's too late. Now, quick reality check. My analytics show a big chunk of you watch these videos regularly but still haven't subscribed. If you get value here, support the work. Hit subscribe, and in the comments, write OG John AG so I can see who's really riding with me. Also, if you want daily updates, quick posts, and my personal takes that I don't always put on YouTube, plus instant voice notes when something breaks, I've opened a WhatsApp channel. The link is in the description. Join it because the market doesn't wait for upload schedules. And one more thing, by the time you're watching this, a members-only video should already be live. One single video with the key updates so far, plus deeper analysis for people who want the full picture. If you want to know who's actually following closely, that's where we'll be. All right, let's jump in. And I know some of you are thinking, okay, but what's the one event that kicked this off? It's not one event, it's a chain reaction. When you hear about sudden pressure on an oil-heavy country, that's not just about democracy or stability, it's about barrels, it's about pipelines, it's about who gets paid in what currency and who gets locked out. When you hear about an Arctic territory suddenly being treated like a prize, that's not about flags. It's about the minerals under the surface and the shipping routes above it. It's about who controls the future map. And when you hear about tension escalating around a key Middle Eastern nation, that's not just about ideology. It's about energy flows, regional influence, and whether the region settles trade in one currency or multiple. Now, I'm going to say something blunt. In this environment, headlines are often decoys. The real story is what the headline allows someone to do next. And here's the cliffhanger that most people miss. Every time a power tries to secure a resource region by force or pressure, it accelerates the other side's motivation to build alternatives. And those alternatives almost always involve moving away from the old settlement system. So the more aggressive the moves get, the more likely it is that the financial plumbing changes faster than the public expects. That's why you're watching two fights at the same time. A physical fight over resources and a financial fight over the unit of account. Now, I want you to remember this phrase because it's going to keep showing up in 2026. You can't sanction geology. You can sanction people. You can sanction banks. You can sanction shipping firms. But if the world still needs the metal and the metal still exists in the ground, someone will find a way to trade for it. And the more often that happens outside the legacy system, the more the legacy system weakens. That's the big why behind the price action you're seeing. Okay, back to the plot. Let's talk about why the US is suddenly acting like it woke up and discovered the real world again, because for a long time, the country could run an empire on credit. And yes, that credit came with a cost, but it was manageable as long as the world kept recycling dollars back into US assets, and as long as US borrowing costs stayed low enough to pretend the bill didn't matter. But that era is cracking. This is why resource security becomes urgent. When your balance sheet is stretched, you can't afford to be cut off from critical inputs. So you push, you negotiate aggressively, you threaten, you offer security guarantees, you do whatever you have to do, because the alternative is a slow decline in industrial capability, military readiness, and economic comfort. And here's where the multipolar world makes this situation uniquely uncomfortable. In a unipolar world, you could assume others would comply. In a multipolar world, others can say no and still survive. That changes everything. Now, let me connect that to silver in a way that's impossible to ignore. Silver is a bottleneck metal. It doesn't have to run out to create a problem. It only has to get tight enough that delivery times stretch, premiums rise, and industries begin competing with investors and savers. And because silver is relatively cheap per ounce compared to gold, it's psychologically easier for regular people to accumulate. That means when fear rises, silver often sees waves of retail interest that can stress a tight market even more. So we have industrial demand, we have monetary demand, and we have geopolitical risk. That's a nasty cocktail. Now, let's talk about the bigger forces behind what you're seeing. When a world moves from one dominant center to multiple power centers, the competition shifts from financial engineering to resource security. Rare earths, critical minerals, industrial metals, these aren't optional. They're prerequisites for defense systems, AI infrastructure, energy storage, and high-tech manufacturing. And here's the uncomfortable part. A lot of the refined supply chain for those materials has been concentrated outside the US for a long time. So what happens when you realize late in the game that a large percentage of the minerals you rely on for both military capability and modern technology are sourced from a rival sphere? You panic, or at least you start issuing executive orders, drafting strategies, and suddenly caring about domestic mining and processing capacity again. But the real world doesn't scale on slogans. Mines take time, refineries take time, skilled labor takes time, environmental permitting takes time, capital takes time. So in the short run, if you can't build your way out fast enough, you try to secure what exists through alliances and leverage. That's the backdrop. Now let's talk about the dollar, because you can't separate resource competition from currency competition. People love to talk about the dollar like it's permanent, like it's gravity, like it's simply the default because it's the default. But that's not how reserve systems work. They work because of incentives, enforcement, and convenience until they don't. A major shift started years ago when big energy producers began deepening ties with non-Western buyers and signing agreements that weren't just symbolic handshakes. They were practical investments, infrastructure, tech transfers, logistics corridors, and multi-dead deals that slowly reduced the necessity of transacting everything through one pipeline of dollars. A few years back, a high-level summit in the Gulf made headlines because it wasn't one agreement. It was a stack of them spanning energy, transportation, construction, advanced technology, cloud infrastructure, and industrial build-out. The number of deals was large, and the announced value was enormous. But the deeper point wasn't the press release. The deeper point was this: when you lock in investment and infrastructure partnerships, you're also locking in future trade flows. And trade flows decide currency usage. That's why the petrodollar conversation matters. Not because it's a conspiracy phrase, because it describes a mechanism. After the US broke the last tether to gold in the early 1970s, it needed a new anchor for global demand for dollars. The basic idea was straightforward. Keep oil priced and settled predominantly in dollars, and you force global demand for dollars because the world needs oil. That system helped the dollar stabilize in a crucial period. But it was never magic. It was a deal. Deals can be diluted, renegotiated, or bypassed. And now the bypass is accelerating. Some countries want payment optionality. Some want reduced exposure to sanctions risk. Some simply want leverage. Whatever their motive, the result is the same. The dollar's role is still large, but it's no longer unquestioned. So here's the problem for the US. If you can't rely on effortless resource access through your currency, you must secure resources through supply chains, partnerships, or direct control. And that's why the resource scramble feels so frantic. Now, before anyone mishairs me, the dollar is still everywhere. Global FX turnover still sees the dollar on one side of most trades. That's real. But everywhere doesn't mean safe, because even if the dollar stays dominant, its purchasing power can still decline. You don't go broke because your currency stops existing. You go broke because it buys less, and that's why commodities matter, especially monetary metals like gold and silver that don't depend on a counterparty to remain valuable. But here's where things get spicy. The US has burned a mountain of treasure across decades: foreign wars, security commitments, nation building, and endless projects with questionable returns. In some places, it spent decades and walked away with little to show except receipts. In other places, trillions were spent and stability is still elusive. Meanwhile, the bill at home keeps growing. Defense spending is enormous. Interest on the national debt is enormous. And the debt pile itself is enormous. That's not a political statement. That's arithmetic. And when you combine that with corporate debt, consumer debt, and the giant derivatives iceberg nobody wants to talk about, you begin to see why policymakers look like they're trying to outrun a fire, because they are. Now add the multipolar reality on top of that. When your currency system faces friction abroad and your balance sheet is stretched at home, you become extremely sensitive to anything that threatens resource access. So where does silver fit into this? Silver is not just a shiny investment. It's an industrial input that powers modern tech. It's used in electronics, solar, medical applications, and high-end manufacturing. And it's also a monetary metal with a history of being used as money across civilizations. That dual role matters because it means silver demand can hit you from two directions at once: industry and monetary defense. And here's a critical vulnerability. A big chunk of US silver consumption is met through imports. Depending on how you measure it and what year you're looking at, the reliance is heavy. That means supply chains matter, trade relationships matter, and in a world where relationships are being renegotiated, That's not a minor detail. Now, look beyond the US. Demand isn't coming from one place. We've seen record import behavior from major buying nations. When a country begins ramping silver purchases dramatically month after month, especially in dollar terms, it tells you something. Somebody is treating silver like a strategic asset, not a weekend hobby. And you can feel it in the market. Because while the paper side of the silver market can move price in the short term with leverage and liquidity gains, the physical side has a different constraint. You either have the metal or you don't, which is exactly why we keep seeing the same pattern. Overnight in thin trading, price gets slammed, stops get triggered, the headlines get written, the narrative gets pushed. And then during regular hours, when physical buying shows up, price starts crawling right back. It's like watching someone try to hold back a flood with a broom. And I want you to understand why this matters, because it's not just volatility, it's a tug-of-war between two worlds. The paper world that can create claims and the physical world that can only deliver what exists. Now, I'm going to show you the macro view in a second. But first, let me ask you something that I want you to answer in the comments. Do you think the next big shock will come from a currency event or a supply chain event? And here's a second one. If silver makes another violent move, up or down, what do you think will be the real trigger? A news headline or physical shortages getting exposed? Drop your thoughts. Also, quick friendly reminder. If any of you are doing well, maybe you caught a move, maybe your business is thriving, maybe you made a smart decision in the last year, share a sentence about it in the comments. Success is contagious, and your story might be the push someone else needs. Now, let's zoom into the demand side again, because this is where it gets fascinating. We've seen certain nations buying silver at record rates in dollar terms. That matters because it hints at strategic behavior. If a country is importing a lot of silver, it could be for industry. It could be for investment demand. It could be for reserve diversification. Or it could be for all three. And when you pair that with broad buying in the Gulf region, where wealth funds and institutions have a history of hedging with precious metals, you begin to see a picture. The non-Western bloc is quietly stocking up on hard assets, while the Western bloc argues about narratives. And then on top of that, you've got the rare minerals issue. For years, a huge share of rare mineral processing, especially the refined, usable part, has been concentrated in Asia. That's not an insult. That's a fact of industrial development and supply chain investment. But the strategic consequence is severe. If you rely on a rival sphere for the refined materials that power your military tech and your AI infrastructure, you are vulnerable. So what do? You try to reshore, you try to friendsshore, you try to build processing capacity at home, and you try to secure access abroad. All at once, which is why the competition for resource territories is heating up at the exact same time that metal prices are rising. Now, let's go back to the currency mechanism, because this part is where most investors get lazy. They assume the world uses dollars because it has to, but currency usage is a network effect, and network effects can weaken slowly until they weaken quickly. What happens when major energy producers sign massive long-term investment frameworks with large buyers outside the traditional alliance system? It means future oil, gas, and industrial projects are increasingly coordinated in a way that does not require Western financial infrastructure. What happens when the same producers and buyers build logistics routes, industrial zones, and tech partnerships? It means trade gets stickier, and sticky trade reduces the need to recycle dollars through U.S. assets. Again, this doesn't flip overnight, it bleeds, it spreads. And that's why in this transition, hard assets are not speculation, they're insurance. Now, let me lay out the next cliffhanger. If resource competition intensifies, governments will respond. Sometimes they respond with diplomacy. Sometimes they respond with military positioning. But very often they respond with financial measures, export restrictions, import bans, sanctions, capital controls, or regulatory pressure. And every one of those measures has second-order effects. They distort supply, they raise costs, they push buyers into alternative channels, and they increase the appeal of portable permissionless assets like physical metal. That's why this cycle feeds itself. Now, I want you to understand something else about silver that doesn't get enough attention. Silver's supply doesn't respond quickly to price. Even if the price spikes, new supply doesn't magically appear next month. Much of silver comes as a byproduct of other mining. That means silver supply depends on the economics of other metals. So even if silver goes to a much higher price, supply response can be slow and uneven. That is why tightness can persist. And that's why physical demand matters so much. Okay, now we can move into the chart work with the right mindset. Because the chart isn't just lines. The chart is behavior under stress. And right now the behavior is telling you that the market is trying to reprick scarcity, while a leveraged paper structure tries to keep the lid on. That is the battle. Now, let's get into the charts, because if you don't zoom out, the daily noise will mess with your head. First, gold. On a weekly chart, the story is simple. Gold has been grinding higher, and even with pullbacks, it's been holding levels that used to be unthinkable not long ago. People who stare at 5-minute candles think every dip is the end. People who look at the weekly see something else, a market that's digesting gains and preparing for the next leg. But the monthly chart is where it gets really interesting. When you pull gold back decades, you see the old peaks, you see the long consolidations, and you see the breakouts that change the narrative. At certain points, gold doesn't just rise, it breaks a psychological wall that resets the entire discussion. A key level was broken not too long ago, an area that acted like a ceiling for years. When gold punched through, it didn't just keep running, it did what strong markets often do. It came back, tested the breakout, and then resumed higher. That retest is the part most people misunderstand. They see it as weakness. It's often strength. It's the market checking whether the new level is real, and when it holds, it builds a base for the next move. Now, silver. Silver is the wilder cousin. It moves faster. It scares people out more, aggressively. And it rewards conviction more violently. On a weekly chart, you can see the reality beneath the drama. Yes, silver gets hit. Yes, it whipsaws. But zoomed out, it has been climbing. And the moves are not random. They're part of a bigger formation that has been building for years. And when you go to the monthly chart, you can see why so many long-term silver watchers have been talking about this period like it's a once-in-a-generation setup. You've got a massive multi-dead base. You've got a structure that when it finally breaks, doesn't just create a rally, it can create a repricing. We saw an important breakout phase, then a pullback that looked scary to anyone who only watches short time frames, and then a recovery that confirmed the breakout zone wasn't a mirage. That's exactly how a long-term bull market often behaves. Break, retest, launch. Now, let's talk numbers for perspective. Silver closed the previous year around the low 70s. Recently, it traded around the low 90s. Do the math, and you're looking at roughly a 25 to 30% move in a short period. That's not normal. That's a message. And this is why I keep hammering this point. The paper market can create the appearance of abundance, but physical demand is not fooled by appearance. And this is why the overnight smashes have been losing their psychological effect. Because people who want physical metal don't panic sell because of a 2 a.m. candle. They place orders when they see dips. They pull inventory when they see weakness. And every time that happens, it reduces the metal available for the next wave of demand. That's how tight markets get tighter. Now, I want to connect this to the bigger asset rotation because this is where the real cliffhanger sits. If you look at broad stock indices priced in silver, meaning you measure stocks not in dollars but in ounces of silver, you get a very different picture of wealth. For decades, there has been a long trend that favored financial assets. Stocks outperformed in dollar terms, and people built entire identities around the idea that paper assets always win. But ratios tell the truth that headlines hide. When the S&P to silver ratio starts breaking down through long-held trend lines, it signals that silver is beginning to outperform stocks on a relative basis. And that matters because it suggests capital is rotating slowly at first and then suddenly. The same story shows up when you look at the Dow to gold ratio. When that ratio breaks key levels, it often marks a shift in the cycle away from paper dominance and toward hard asset strength. Does that mean all money flees stocks overnight? No, markets don't work like that. But even a modest shift in allocation from a gigantic pool of paper wealth into a much smaller market like silver can create outsized price moves. Because silver is small, the silver market does not need the entire world to buy it. It only needs a relatively small slice of global capital to decide it wants a hard asset hedge. And then the math gets uncomfortable fast. Now, let's bring this back to the geopolitical backdrop again, because this is the part that turns chart talk into reality. When energy producers sign huge multi-sector deals with emerging powers, when trade corridors are built that bypass traditional choke points, when sanctions risk pushes countries to build alternative settlement rails, and when the US discovers that it imports too much of the metals it needs. This isn't theoretical. This changes behavior. Governments stockpile, industries secure contracts, investors front or run scarcity, and banks that lived in the world of paper promises begin to realize that paper promises are only as good as delivery, especially when delivery gets harder. That's why you're seeing paper attacks collide with physical demand. And that's why the silver story isn't just a trade, it's a symptom of a world that's reordering. Now, before we continue, I want to do something creative for 2 seconds, because I know many of you love real-world proof, not just charts and theory. If you want to hear actual silver-related success stories, regular people who spotted opportunities, protected their savings, or built wealth in unconventional ways, there's a separate channel linked in the description. Take 10 seconds after this video, check it out, and subscribe there too. It's a different vibe, and you'll probably find it motivating. All right, back to the main plot. Here's what a lot of people still don't fully grasp. In a multipolar world, resource security becomes a national survival issue. That means competition intensifies. And competition intensifies in ways that can look chaotic from the outside. Why do you think countries care so much about shipping routes? Because resources move on ships. Why do you think certain regions suddenly become strategic partners after decades of neglect? Because resources live there. Why do you think an island, a desert, or an icy landmass can suddenly become the center of diplomatic attention? Because underneath that ground are materials you can't replace with an app. And as this competition heats up, the temptation grows to use financial tools, sanctions, trade restrictions, currency pressure to force alignment. But every time that happens, it also encourages the other side to build alternatives. That's the feedback loop. And in that loop, hard assets become more attractive. Now, let me bring you to a specific psychological trap that wipes people out in this kind of market. Silver moves up fast and people feel late. Then silver drops fast and people feel stupid. Then they sell, swear it off, and miss the next move. That cycle is not an accident. Volatility is a weapon. It shakes out weak hands and transfers metal or exposure to stronger hands. So if you want to survive this environment, you need a macro anchor. That's why we zoom out. That's why we look at monthly charts. That's why we use ratios. Because the goal is not to win every hour. The goal is to avoid getting emotionally harvested by the market. Now, let's address the paper attacks directly. Why do they hit overnight? Because liquidity is thinner. It's easier to move price with fewer contracts. It's easier to create a scary candle. It's easier to trigger stops. And it's easier to manufacture a narrative. But here's the weakness. If the physical market is strong enough, the paper attack becomes a discount event. It becomes a buying opportunity. And if enough buyers treat it that way, the attackers spend more and more effort for less and less effect. That's what losing battle looks like. Now, we've already seen that physical interest remains intense, and we've already seen that buying is not limited to one country. It's broad, it's persistent, and in some places, it's accelerating. So the question becomes, what happens next? This is where the cliffhanger lives, because silver doesn't have to rise smoothly. In fact, it rarely does. Silver tends to move in steps. It coils, it frustrates, it explodes, it pauses, then it explodes again. And when you combine that behavior with a world that is repricing resource security, you get the kind of market where normal models break. Now, I'm not here to tell you a specific day or hour this happens. Markets are too complex for that. But I am here to tell you what the structure suggests. The longer the base, the bigger the move. And if the macro backdrop remains what it is, debt expansion, currency debasement, geopolitical fragmentation, and physical scarcity, then silver has reasons to remain bid beyond short-term noise. Now, let me fold in one more key point about spending in desperation because it ties directly to why this fight over resources is escalating. A country can run enormous deficits for a long time when it can export inflation and import resources cheaply. But when that privilege is challenged, even slightly, everything gets more sensitive. Interest costs rise, defense costs rise, domestic political pressure rises, and suddenly securing supply chains becomes a priority that overrides elegance. That's why you're seeing aggressive posture. That's why you're seeing urgent policy moves. And that's why, in my view, the narrative war around metals is only going to intensify. Because if more people decide to convert currency into physical metal, that is a vote of no confidence in the system. And systems do not like no confidence votes. Now, let's take a breath and go even higher level. Gold is the reserve metal. It's the one central banks have historically used to anchor trust when currencies wobble. Silver is the people's metal and the industrial metal. It is both monetary and functional. When both gold and silver trend higher together, it often signals that something bigger than a trade is happening. It signals monetary stress and a search for real value. And when silver starts outperforming, it often signals acceleration because silver tends to lead in the emotional phase of the cycle. So if you're watching silver's volatility and thinking this is crazy, you're not wrong. But crazy is not the same as bearish. Crazy can be a symptom of a market trying to re-prick itself. Now, let me tie this back to you personally, because that's the point. You don't need to become a geopolitical expert. You don't need to memorize every summit and every agreement. You just need to recognize the direction of the world. Less unity, more rivalry, less trust, more hedging, less paper confidence, more physical demand. And in that world, the question isn't, will everything be stable? The question is, what do I own that stays valuable when the rules change? That's why this matters. Now, I want to give you one more quick engagement nudge because honestly, the comment section is where we build the real community here. If you've ever bought a hard asset, metal, land, a business, anything tangible, what was the moment that pushed you to do it? Fear, opportunity, a lesson learned the hard way. Tell me below. And if you're comfortable, share one small win you had recently. It helps others more than you think. All right, final stretch. Here's my base case. We're watching the collision of three forces. Force number one, the world is splitting into blocks and resources are becoming the center of power. Force number two, debt and currency debasement are pushing people toward hard assets, whether they admit it or not. Force number three, the paper market structure in silver is being stress tested by steady physical demand from multiple directions. When those three forces overlap, you get a market that will punish the emotional and reward the prepared. And if you want to be prepared, you need information flow. That's why I'm pushing the WhatsApp channel, because when something breaks, you don't want to find out 2 days later after the move. That's why I'm pushing the members only video, because if you want the full update in one place and deeper analysis, that's where it's going. And that's why I'm pushing the subscribe button, because the only way we keep building here is with your support. So here's your simple action list. Subscribe. Join the WhatsApp channel via the link in the description. If you want the deeper recaps and premium breakdown, check the members only video. And in the comments, write OG John AG if you want to back the mission. Because yes, there's also something else going on behind the scenes. I'm running a campaign to eliminate copycat channels that recycle content without adding value. If you respect original work and you want this space to stay clean, help me out. Subscribe and comment OG John AG. That signal matters more than you think. Now, as we wrap up, I want to bring you back to the very first line. Exactly what happened. What happened is the world moved another step toward a resource-driven reality. And silver quietly, stubbornly, keeps exposing the difference between paper confidence and physical necessity. We're not just watching a price chart. We're watching a system adjustment. So keep your head, zoom out, watch the ratios, ignore the noise, and don't let a thin market candle talk you out of a multi-year trend. If you found this helpful, hit like so the algorithm pushes it to more people. Share it with one friend who still thinks commodities don't matter.